Hello. Okay, we're going to go back and finish the rest of the chapter 7 video. So I'm going to pick up right where I left off. So we had just finished the periodic example and we had just finished the income statement. And now we're going to do perpetual. Remember from chapter 6, the difference between periodic and perpetual is that periodic is at the end of the year, you say, I have this many units left, and you calculate how many were sold. Perpetual means every single time you make a sale, we're going to stop and say, which units did we sell? So every sale, you're going to compute Cogs instead of waiting until the very end. So with the periodic method, at the very end, we figured out that we sold 300 units, and then we were like, which units? Now, every single time we make a sale, we're going to stop and figure out which units we sold. So this table is what you're going to fill out for homework and for the chapter 7 project. So what we're going to do is we're going to have 4 sets of columns. This set of columns, the first set of columns, is for when we sell units. So in our transactions, it looks like we're going to sell units on April 10th, June 19th, and November 28th. So just the times we sell units. This set of columns, is for when we purchase goods. So we're going to purchase goods on March 5th and September 16th. And so we will also compute Cogs every single time we sell units. When we put something in these columns, we will also put something in these columns. And then this inventory is going to be a running balance of inventory. So we are going to put something in each row for exactly what we have in inventory after every single transaction, which sounds like a lot, but it's not bad. So above here, I usually write something like running balance, so that we keep track of this inventory every single time. I feel like there's something underneath here. There's not supposed to be. So just a second. Oh, okay. I deleted it, and I'll try to go in and fix that in the given. So just a second here. Okay. So let's go ahead and let's compute these. And so we are going to start on January 1. On January 1, when I got to work that day, I opened up my doors to my business. I had 80 units at 120. So I'm going to come over to my inventory balance, and I have 80 at 120. 80 times 120 is 9,600. So that's where the 9,600 comes from. So on that day, that's what I have for inventory. So apparently nothing happened between January 1 and March 5th, but on March 5th, I'm going to buy 80 units. I must know that something big's about to happen. And I am going to go and I'm going to purchase 80 units, and the price went up to 125. So 80 times 125 is 10,000. So that's what I purchased. Now I didn't sell any on March 5th, so I don't need to put anything here. And because I didn't sell any, I don't have to compute any cost of goods sold. But over here, and this is the important part, I am going to say I still have 80 at 120 for 9,600, and I have an additional 80 at 125 for 10,000. I know it feels repetitive to write it again, but after every single transaction, you're going to say, all right, what do I have right now? So April 10th rolls around and we're going to sell 60 units. So when you sell units, you're going to put it in the sales column. 60 units at 245. Now that's what you charge the customer. Obviously, we want to make money. That's why we're in business. So we are going to sell 60 times $245 each. So the customer is going to give us $14,700. I didn't buy any, so I'm going to skip this set of columns. And now this is the important part again. I have to figure out the cost of the good that was sold. I know I sold 60 units. I need to know what the cost of those are. Now you're tempted to put 245 here, but you can't put 245. That's what you sold it for. I need to know the cost. So now I have to pause and be like, all right, what method am I using? And I am using Fifo. What's Fifo? First in, first out. First items in are the first ones to go. So these are the goods I have. I have 80 at 120 and I have 80 at 125. First in, first out says that I'll sell the first units first. So how many units did I sell? 60. And the cost of the good that was sold will be 120. So 60 times 120 60 times 120. There we are, 7,200. And now we pause and we say, what do we have left? So of these units, I sold 60 of them. So I only have 20 left. So I have 20 at 120 for 2,400. And I still have my 80 at 125. Okay. So here I had 160 units on my shelves. I started the year with 80. I bought 80 more. I had 160. I sold 60. So I have 100 left. 20 of them are $120 units. 80 of them are $125 units. All right, June 19th rolls around and I'm going to sell an additional 70 units at $245. So I'm selling units. And so I'm going to put them here, 70 at $245. 17,150. So I didn't purchase any. So cost of goods sold, first in, first out. I'm going to sell 70 units. So I need to sell 70 units. Just like here, I had sold 60. So I used 60. Here I sold 70. So I need to sell 70. First in, first out. The first items in are the first ones to go. So I'm going to sell all 20 of my 120. And then I need to sell a total of 70 units. Because of this 70, right? So I sold 20 at 150 or 20 at 120. Now I need to sell 50 at 125. So 50 times 125 is 6,250. Okay. So the reason why I used 50 is because I sold 70, 20 of them. I only had 20 units left at 120, and then I had to move to the next row. So of these 80, I sold 50. So I did not sell 30 at 125. That's it. 30 times 125. Yep, 3,750. So I'm running low on units. I don't know what we sell. I'm running low on units. I only have 30 left. So looks like I'm going to run out and I'm going to buy some more units. So on September 16th, I'm going to purchase 60 units at 130. More inflation. 60 times 130 is 7,800. I did not sell any units on September 16th, so I don't need to compute cost of goods sold. But I still have 30 at 125. And now I just bought another 60 at 130. And on November 28th, I'm going to sell 55 units. 55 at 245. 13,475. First in, first out. I'm going to sell 30 at 125. And I need a total of 55. So another 25 at 130. 32.50. So that when I sell 55, I have 55 here, just like I sold 70 and I had 70 there. So all of these are gone. And of these 60, I sold 25, so I still have 35 left. So 35 at 130. 4,550. All right. So now what I can do is I can go ahead and do some totals. So in total, it looks like my revenue, it looks like I made sales to customers 3 times. So my total revenue is 14,700 and 17,150 and 13,475. 45,325. I can total this column, but I don't need it anywhere on the income statement. So I don't normally. If you want to put a total, I don't care. It's 17,800. So if you want to, you can. For Cogs, it looks like we sold goods 3 times. I have that number. I have these 2 and these 2. All of those total, though, my cost of goods sold on my income statement. So this is in my way. Oh, well, that's okay. 7,200, 2,400, 6,250, 3,750, and 3,250, 22,850. Now, on this one, students want to total this because that's what we've always done. But I want you to notice the duplication. This was a running balance. So every time we bought more goods, we repeated our original goods and put more in. And every time we sold goods, we updated it. So every single time we updated our balance in inventory. So when we get to the end, We do not total up this whole column. We only total up the last day. The last day is these two. So there's only one number there. So our answer is 4550. And that's the number that would show up on inventory on our balance sheet. So we would start the next year with 35 at 130, and that would become the balance at the beginning of the next year. And then we would buy some and sell some and buy some and sell some, and we would end with some, and we would start the next year. So this is a FIFO table. So for your project, you'll do a FIFO table and a LIFO table. For your homework, you'll do a FIFO table and a LIFO table. It should go well. I love these. Students usually like these. I don't know. They're pretty straightforward. So the next page, though, is some journal entries because we haven't done any journal entries yet on this chapter. The nice thing is these journal entries are all ones we saw in chapter 6. So no new entries here. So do journal entries for all purchases and sales. So we don't do a journal entry for January 1 because that would just be the beginning balance in the T account, but we would do a journal entry for each of these transactions. So just to show the relationship between the journal entries that we've always learned how to do and this random table. So on March 5th, we purchased 10,000 of inventory. It says all purchases and sales are on account. So when we buy inventory, we put it in inventory, and that was 10,000. We're going to pay later. On April 10th, we sold inventory. So revenue of 14,700, COGS of 7,200. Now, when you sell inventory, there's always two parts. So we have the sale with money coming in, and we have the expense with money going out. So with inventory leaving the building. So every time we sell inventory, we do a journal entry that looks something like this. Yeah, where's Kennedy? She's with Mary. Mariana? Okay. Thing okay? Is that why you're upset? Okay. Okay, so accounts receivable and revenue and COGS and inventory. Okay. So accounts receivable. Hey, Lauren, I just remembered we're going to a football game shortly. I have to make this video. I'll have to talk to you about it later. Just give me some time. Okay, so accounts receivable 14,700 and 7,200. Sorry. So this is the sale. If we received the money now, we would put it in cash, but we're going to receive the money later. And then the inventory did leave the building when we made the sale. Now that 7,200, I had to compute that. I had to find that number. And that was the cost of goods sold at 7,200. So, okay, next one, June 19th, same accounts, just updated numbers. On our June 19th sale, it was for 17,150. And the cost of the good that was sold. Okay, it's both of those. So I need to add them together. I think that's what it says. Now I'm a little bit worried about it. So this is all in my way. I can't seem to get a hold of it. Okay. Yeah. So 2,400 and 6,250. Yeah. Okay. So it said 8,650. All right. June 19th, we're going to buy some inventory. When we bought inventory on June 19th, it was 7,800. And then on November 28th, we're going to sell inventory. Every time you sell inventory, you'll have the money coming in eventually and the inventory going out. So it was 13,475. And the cost of the good that was sold is these two numbers added together, 3,750 and 3,250. 7,000. So what is the gross profit? Would be revenue minus COGS. So your revenue is the total revenue here, 45,325. And this would be the top of the income statement, right? Revenue minus COGS is gross profit. And then COGS comes this right here out of the table, 22,850. And then from there, okay. Okay. Asked for 22,475. So what we see here, we would be able to keep going if we knew our expenses like rent and utilities and stuff, and then we would get net income before taxes. And then if I had a tax rate, I could do tax to get net income. So I could keep going, but I don't need to practice that concept again. It's at the top of page 3 of your notes. Okay, so now what I need to do is I need to do the exact same table, and instead of FIFO, I'm going to use LIFO. So when I do LIFO, let me go ahead and delete the information. Okay, and so I'm going to do the exact same transactions, but using LIFO instead of FIFO. So I'm going to start off with 80 units. Okay, and then on March 5th, I'm going to buy some more. So I still have 80 at 120, and I have another 80 at 125. Then on April 10th, I'm going to sell some units. When I sell units, I sell 60 at 245. If I were good at this, I'd remember the number, what that math is, but I'm not there today. 14.7. So now I need to know the cost of the good that was sold. I know I sold 60, but now I haven't had to even think about if I'm using FIFO or LIFO yet. This table is LIFO. And since it's LIFO, I'm going to do the last items in are the first ones to go. So instead of FIFO, I'm using LIFO. So I'm going to do 60 at 125. 7,500. So I still have 80 at 120. And now I only have 20 of my $125 units left. On June 19th, I'm going to sell another 70 units at 245. 17,150. The cost of the good that was sold, LIFO, last in, first out. First, I'm going to sell my 20 at 125. And then I will sell another 50 at 120. 6,000. So what I'm left with, all of these are gone. And then I moved on to these. I sold 50 of them, so I only have 30 left. On June 16th, I'm going to buy 60 more units at 130. 7,800. So now I have 30 at 120. They probably got dust on them. And 60 at 130. And then on November 28th, I'm going to sell 55 units. 55 units at 245 is 13,475. And then which units? Last in, first out, I'm going to sell them out of the last ones. So I'm going to sell 55 at 130. 7,150. So I still have my 30 at 120. I only have 5 of my $130 units left. 50. I should check. I want to mess up. Yeah. Okay. So I have 35 units left here. Let's make sure that I haven't messed anything up. I can't feel weird about it. So I have 35 units here. All right. So I feel good about that. I still have 35 physical units left. Every time we sold units, like physical units, I still have 35 units left. And those units are 30 of them at 120 and 5 of them at 130. So total of revenue. So just look at the other page, 45,325. I do not need to total this column. If you want to do 17,800, but for Cogs, I will do 7,500, 2,500, 6,000, and 7,150, 23,150. And then here we do not total this whole thing. We only look at the last date. So we are only going to total these two. 42.50. Alrighty, so the next thing we're going to do is we're going to compute weighted average for the same data, just to practice one more time on weighted average. So what is the average cost of one unit? So this is this given. So we started off with 80 units, but then we purchased 80 and we purchased 60. So I just kind of summarized that down here. So the average cost of one unit would be 27,400 divided by 220. Oh, look at that ugly number, 124.55. Textbooks are really good at coming up with nice round numbers, but your accounting professor is not. So 124.55. How many units did we sell? I have no idea. We sold 60 and 70 and 55. So that's 130, 185. So Cogs would be 185 times 124.55. Okay, so let me go. Let's just do 23,041. Okay. And then ending inventory, we still have 35 units left. And I remember that from above, but the way you would find that is 220 available. You sold 185. So you've got 35 left times 124.55. And so we'll do 43.59. And just to check myself, these two numbers added together are always the total cost. So because all units are either sold or not sold. All units are either sold or not sold. Yes, correct, Claire. Okay. So this is just a little bit information on the fact that like normally prices are rising. So LIFO will create more COGS and that will create less taxes because more COGS, more expenses mean less taxes. FIFO usually makes your ending inventory look better. So your assets look better. So, so last thing that we need to do, just a tiny bit of, is to calculate purchase discounts, which is very similar to sales discounts. So when you buy inventory, you might be given a discount, just like when you sell your inventory to your customers at 210 net 30 thing. So we're going to practice this with 310 net 30. So it says, on February 2nd, Ham purchased 40,000 of inventory. So when we buy the inventory, we are going to debit inventory and credit accounts payable. And then when we go to sell the inventory, I don't know why it's on funny lines like that. Let's just do that so it's all together for now. That's fine. When you go to sell the inventory, or when you go to pay for the inventory, we need to pay off the accounts payable. And then we're going to pay cash on the bottom row. Okay. So what we have to consider here is if it's 40,000 and we take the discount would be 40,000 times 0.03. So we're going to get a $1,200 discount for paying early, which is beautiful. I love that. So when we go to pay for the inventory, we are not going to pay 40,000. We are only going to pay 38.8. So that's how much cash. So we need a credit to cash for 38.8. So, so we need to pay off the entire accounts payable though. So here's what the journal entry will look like. Okay, so let me come back to that. So accounts payable is 40,000, but I'm only paying cash of 38.8. And so if we use the same concept as before, we would use purchase discounts. So purchase discounts is the account that you feel like you should credit. But if you're using the perpetual method, you actually just reduce the cost of your inventory. So we actually put inventory right here because the inventory's cost we thought was going to be 40,000, but we're reducing it by 1,200 to show that we're really only paying 38.8. So I don't think you'll do any of those kinds of journal entries except for just recording purchases and stuff. So in a periodic method, though, you do use an account called purchase discounts right here. All right, and then there's a little bit of ratio information here. I don't actually do a lot of homework with ratios at this point, but inventory turnover ratio, basically, you're going to learn about that in finance class. It just tells you how long it takes you to turn over your inventory. How often do you turn over your inventory? So you take COGS divided by your inventory. So as an example, if you had 30 cars on your lot and you sell 300 cars a month, then you turn over your inventory 10 times a month. Okay. So again, if you had 300 cars you sold in the month and you normally have 30 cars on your lot, 300 divided by 30 would mean you sell all of your cars 10 times a month. Now, what that doesn't mean is every single car gets sold 10 times, because obviously you might have one car that sits there the whole month, but it just tells you on the average how often you turn over your inventory. And you want to do that as often as possible. I mean, my students that sell cars now, would love to sell 300 cars every day, not just 300 cars a month. And so bigger is better. And so you can also convert that to days. So if you turn over your inventory 10 times a month, then you could say that, and I was doing monthly instead of yearly. So basically you could say that you can do it monthly and say you turn over your inventory every 3 days or whatever. So, so if we said that we sold 300 cars a year, and the average inventory is 30, then you'd say your inventory turnover ratio is 10. So days to sell would take 36.5 days to sell all of your inventory. But we don't do any of this kind of stuff necessarily. So, all right, you're ready for your chapter 7 homework and project. And so in the intro video, I'll try to give you some homework help potentially. So, but I did a lot of it. I made some notes for you, and I think everything's going to go great. So I will talk to you later. Thanks.